Matthew Luzzetti, go American narrow here. Where's the underlying business investment, the first and second derivatives that have to do with getting to earnings after revenues? Where does that dynamic stand right now?
I think the second derivative on growth is definitely negative. We're coming from, as was mentioned, we're coming from a world where the U.S. economy was growing 3%. A large part of that in the first half of last year was CapEx, which was stronger than expected. So absolutely, you should be expecting a deceleration. I think what you have seen, though, is what was priced into probably equity markets. What has been priced into the bond market is much worse than what we're likely to get. So you've had these inversion of the yield curve, which we're now on pricing some of that. Equities, I think, have come back closer to in line with where we're seeing the ISM and the PMI. And so you had too much pessimism built into markets. We are now, I think, more fairly priced for the economic outlook.
Matthew, should investors stay short of volatility in the United States and Europe? What will it take to get volatility rising?
Yeah, I think not only in equities, but the MOVE index bond volatility has been incredibly low. I think a key fundamental driver for that is what we're seeing from central banks and the dovish pivot from central banks across the board. And in particular, them moving to calendar-based type guidance. The ECB certainly has that. The Fed, with their patience story, has that as well. And we don't have the Fed raising rates for over the next 3 years. We have them on hold. So unless central banks are going to be a source of volatility, you're unlikely to see volatility move higher. And I think you need inflation to pick up to see that. And so far, we don't see that yet.